All right, looks like we're live. So, hello everybody, I'm Joel Palafinkel. I'm with Sutton Capital. We're a community of fund managers and LPs, and I'm just really excited to introduce a close partner and friend of mine. We've got Kristina Dayback and Matt DiOrio. Matt DiOrio is a single family office, and he's also involved with Vector AIS. They've supported many of the fund managers in my cohort with just all the support that they need to kind of really just become an institutional next generation fund. So really enjoyed kind of just partnering with them closely. Really appreciate the friendship. So excited to kind of just run through a couple topics. One of the biggest things we want to talk about is really how to engage with LPs. It's currently essentially August 2024. So there's kind of a final sprint for people to get to their first close or even final close before year end. As everybody knows, that's in the entrepreneurial space as a founder or even as a VC, trying to really raise the last couple rounds of capital. You really have until probably November, I would say. And, Matt, Kristina, there's a lot of things that you guys are dealing with in terms of fund managers kind of getting to that point. So you'll have a lot of insights in terms of more clarity in terms of like dates that they should think about. But just wanted to kind of kick things off, set the tone, and just have you guys in the room. And there's some topics that I'm really excited to talk about. So I'm going to stop sharing my screen, and I'm going to remove the screen from the camera. And why don't we just jump right into it? So Kristina, why don't you tell us, and Matt as well, why don't you guys just do quick intros about maybe just your careers, your background, and some of the things that you're doing with Vector. Maybe we start with Matt and talk about maybe the family office first, and then we can hop to Kristina.
Yeah, so I run a single family office based out of Dallas, a small family office. We're relatively new. We only started November of 2021, so coming up on 3 years. My role in the family office is I look for alternatives to invest in. I don't touch the stock market. I don't touch fixed income. I don't know how to do that. I would not pretend to know how to do that. So I spend most of my time on the with TT3. It's the name of our family office. Just looking for fund managers that we want to allocate to. We don't really, and also direct companies. We've invested in a decent number of companies directly. We are the family office side. Since we're so new, we're kind of agnostic about industry, about anything. I know that's people kind of roll their eyes sometimes when I say that, but we are so early days. We don't know what it is, our like long-term, what we like, what we don't like. We're figuring that out. So, my motto is I don't turn down a meeting. I take any and all meetings, whether I think the pitch is going to be compelling or not. And I've been surprised a few times. We've invested in a few things that I'm walking in. I was like, I have no interest in this, but I want to make the connection. So for us, it's been a learning experience. Like I said, we're relatively new. And we're trying to build our network first and foremost, and the opportunities have been coming from there. And then also the family office is an equity holder in Vector. So part of my role, I run the family office, but also I work on Vector in a director of finance capacity. So I, help out where I can, chase billings, payroll, all that good stuff. But for us, we've done some early stage investing that's not Vector. So I'd never worked at a startup before. So for me, it's been great experience to see how these companies come together and all that. And I think it's given us a really good perspective on how these emerging managers deal with this sort of stuff, and how founders deal with, the day-to-day kind of unglamorous stuff of starting a company, like payroll. Like, it's not that fun, but you got to do it. So prior to doing this, I worked at an investment manager in Dallas. And prior to that, I actually spent about 10 years working in public company, corporate finance and planning and analysis, and then kind of went back to grad school at some point and made the switch over to the investing side.
Great. And Kristina?
Definitely. Yeah, Matt, I appreciate all your work with the payroll. Definitely keep that coming. So I have about 16, 17 years in venture and private equity back office experience. Started my career at VMS Fund Administration. They were just recently bought out by Maduro. Spent about a decade there. Moved over to Carta about 6 years ago to start up their fund admin offering. Built that from scratch. moved over to operations at Carta, and then more recently, the past year and a half, I started at Vector as a chief operating officer. And part of my role here is identifying where we can be better in terms of reporting, particularly what we need to send to LPs, how we could be more accurate, efficient, and then just grow Vector as big as we can.
That's really exciting. So one of the first questions I have is, when you're kind of thinking about LP expectations and goals, Matt, maybe you can share some insight from the LP's perspective. What are some things that fund managers should do? One of the key things is obviously if you're on fund one and you're doing a really small early stage fund, you probably are not going to, seek out pension funds and massive, institutions or private equity plans. So I would say, your expectation, you should probably right size, maybe the right type of LP that makes sense. But, what are your insights as far as talking to managers, what they should think about on both ends, managing their own expectations and then also managing expectations with LPs?
Is that specific to emerging managers that kind of know?
Yeah, I would say, yeah, emerging managers, and that's kind of a loaded, constraint. Well, it's just kind of a loaded question too, because emerging, like in the hedge fund space, could be like a $400 million fund, and then in venture emerging is like 20. You could still be 20 million. So, but yeah, I guess funds that are kind of maybe thinking about getting into fund two, and they're maybe halfway deployed through fund one. Maybe what are some expectations they should have in terms of engaging with LPs.
Yeah, I think for me, for us, for our little group, what's most important to me, I don't want to see someone who's raised a $10 million fund one, and then they're like, well, the next fund's going to be $500 million. I think the expectation should be to kind of stay in, there's nothing wrong with that, obviously, but that's something that would give me pause to say, why are we making this jump? If you had that successful of a smaller fund, to me, that seems like a fee grab almost, where you're just like, well, now I want to churn out, get a bunch of AUM and just get the fees, which is, again, fine. Everybody's got to make a living. But that for us, that would be kind of a bit of a turnoff. So I think, again, just when the manager kind of knows what they're doing and they have a specific thesis and they stick to that thesis, that's what we prefer. That's what we prefer to see. I don't want to invest in a fund that focuses in enterprise software, and then all of a sudden they're saying, hey, our next investment is in satellites or something like that. It's completely unrelated. So again, I know that's not for everybody, but that's kind of what we like to see, is really a focus on what you're doing, and also not trying to skip a bunch of steps and just raise a bunch of money to grab fees. Yeah.
And then, another question I have is, how can people tailor the pitch to different types of LPs? And maybe we can talk about the different types, right? So there's, exited founders, there's family offices, then obviously there's institutional LPs. So what have you seen as kind of a good job in terms of tailoring and profiling? I think one thing I would say is maybe just doing some research on the background of the family, right? So if the family comes from real estate, maybe just tailoring a narrative to that profile of the family. And then obviously if they have some previous LPs that were in the real estate industry, maybe sharing some of those case studies or examples of how they solve some certain goals that like the real estate families had. I don't know, those are something that come to mind in my end, but any advice you'd have in terms of kind of tailoring the pitch?
I think you need to get to, if you're going to tailor the pitch, I mean, we've seen a lot that are just, you can tell it's the same pitch for everyone, which is fine. But I think if you're going to get to know, if you want to tailor the pitch, you kind of have to get to know the LPs first a little bit, whether that's just doing some research on LinkedIn or even having an intro call or meet for coffee or whatever, even if it's 15 minutes, just kind of a quick, hey, this is who we are. We want to learn a little bit about you, and then we'll follow back up with a formal pitch at some point. I think if you're going to go do the extra step of tailoring your pitches, then that's not a hard additional step to put in there, where you can just say, all right, we're gonna spend a few minutes meeting this guy and learning about family office that he runs, or learning about the founder. What did the founder do before? Whatever it may be. I think that's very worthwhile. And that, for me, sitting on the LP side of the table, I'd be like, oh, these guys care a little bit about at least meeting us and not just you don't want to, I think as an LP, you don't want to feel just like you're wired in some money and then they never want to speak to you again,
Yeah.
Kind of building relationships here. I know for us, and again, we're very new at this, but I think for us, we're trying to allocate resources in a way that's going to, pay off for all of us, but also to build relationships and network as we go along and kind of hopefully grow the family office that we started.
Yeah. What's, when you think about alternatives, how are you guys thinking about the asset allocation? Obviously there's venture capital, there's probably some private equity and buyout. So how are you guys thinking about portfolio construction when it comes to like maybe funds versus directs versus maybe, I'm seeing a lot of families thinking about buyout as well. So any insight on that? And there's one or two family offices that I saw earlier in this little group here. So, would love to, just get any wisdom maybe for emerging family offices or just kind of founders that are thinking about how they can evolve their holding company and, diversify their investments.
Yeah, that's a great question. We've started out, not because we had a plan to do it, just what we've invested in has been mainly venture type investments. Part of that is, our first kind of, we've just made our 12th direct investment, I think back in November. And my partner and I, his family, we kind of are like, all right, that's fund one. We've done 12 directs. We're going to kind of see how these go. We had a certain amount of money allocated towards this project. We've deployed it, and now we're going to see kind of if we have a knack for it, if we're going to go. So I think we haven't, I don't think we're investing enough dollars, just like we're not writing checks big enough to be like, we want to go in a big private equity fund, because really how over 10 years, what's the return on that going to be? Maybe 2, maybe 3x after all the fees and all that stuff. So venture, considering since we're doing smaller-ish checks now, venture seems to be the space where we're having the most upside. And the managers that we've invested in, we've been really careful of who we selected, because again, we're working, at least this first few years, we're working with a limited number of resources. We didn't want to go, deploy every dollar we had in the first 2 months and then say, oh, we haven't thought this through at all. So that's kind of where we're at in there. We look at everything. I'm trying to make connections with everybody that we can, but that's just where we've ended up kind of our first go around these first about 3 years.
Yeah. Kristina, when you're thinking through, with your hat as the COO, when you kind of have fund managers coming in, trying to be institutional grade, what are some of the mistakes that fund managers commonly make when you see them kind of think through their LP strategy? As they're kind of thinking through, either their first close, heading into the holidays, or maybe maybe their final close. Maybe what are some opportunities that you've seen for fund managers to kind of optimize their process?
Yeah. So usually I'm involved after the fundraising, but I do see a ton of pitch decks and fundraising material. A lot of it isn't necessarily operationally focused, but what I say is missing the majority of the time is the how or the why. So I see a lot of pitch decks with spreadsheets, and I have an accounting background, so I love a good spreadsheet. Numbers tell a good story. But when you're just throwing things in a spreadsheet and it's all hypothetical, it only tells part of the story. What LPs are really looking for is, why are you the person that's going to get them there, and how are you going to do it? So having knowing what your story is helpful, and telling the background of why you're the right person for the role, or you're the person they should trust with their money. Because at the end of the day, like Matt said, they're looking to form a relationship. It's not just, let me send you my money. It's, I'm investing in this person with the hopes of investing in them in the future. And the more that you can get them to buy into you as a person, the better you'll be. As far as timing wise, the summer is always pretty bad for VC. August in particular, I'm not entirely sure why it is, but it seems like everyone goes on vacation in August. So trying to do a first close in August is probably not ideal. It's not impossible, but trying to move around like the summer vacations and the holidays can be pretty tedious. So, I would say start your fundraising process and expect it to last about 12 to 18 months from first day to final close. And just plan ahead.
Yeah, have you guys seen any difference this summer? Because one thing I've seen is this summer, I've definitely seen a lot more activity. I've seen a bunch of AGMs, a lot of people just kind of, getting together more often. There's a lot more, private cocktail events and stuff like that. So have you seen any difference this summer in increased or decreased activity from last summer at all?
I think from my perspective, it's just a harder time to fundraise than it was a couple of years ago.
Yeah.
So you need to get yourself out there a little bit more and gain more exposure. Whereas back in 2020, 2021, even parts of 2022, you could raise a $15, $20 million fund without even trying. So just getting yourself out there a little bit more is probably what's happening now. I don't know if it's any more than what was done like 5, 10, 15 years ago, but it's definitely more than it has been over the past couple of years.
Okay, interesting. Yeah. How about just just a compelling pitch? What have you seen in terms of pitches that have been compelling, and kind of like something that has a lot of the things that make them institutional grade, as far as kind of building that fund pitch and that strategy, and being ready to kind of engage with LPs. What are some of the things that you think checks the boxes?
Yeah, I think
and this could be for both of you guys.
Sure, I could jump in first, and then Matt, you go ahead because you probably have more experience with this. From an institutional perspective, or at least trying to get the savvy investors, you need to understand the ins and outs of the metrics behind your fund and what you're showing them. Like, for example, one of the biggest things that I see is, let's say you're raising a $50 million fund and you're throwing projected investments out there, and your projected investments are $50 million worth of portfolio companies. That's not going to happen. 20 to 25% of your fund is going to be tailored or earmarked for expenses, whether it's management fees, admin fees, audit fees, stuff like that. So just keep that in mind, so you at least know that you're going in with even if they're just fake projections, they're just projections. You have real numbers behind them. And then to be institutional ready, they're going to want to see that you're ready and willing to do an audit, and you have an admin behind you that's kind of professionalizing the service that you're providing.
Yeah. No, that's really helpful. So what have you seen that's helped in terms of, we talked about some relationships, in terms of maintaining those strong GP-LP relationships. I think we started talking about like just post-close engagements with LPs. So what are some things that you think could help to just maintain those relationships over time? Sometimes GPs are kind of thinking about their fund one, and they're kind of building their strategy, and now they're kind of becoming much more mature. So they're giving updates to LPs. Some of the LPs are kind of more of a mentor, and then 6 months later, they're like, look, you know what, we've got some initial interest. We've form the fund. So, in terms of like updates, what are some of the things that you've seen have been helpful in terms of those strategies? How have they kind of maintained those updates and kept in touch with LPs?
Yeah, I think you can kind of tailor your updates to quarterly reporting. So, from an admin perspective, every quarter we prepare quarterly financials. It gives you a breakdown of the balance sheet, income statement, portfolio holdings of the fund. All we do is give them numbers, and numbers tell a story, but it's not the whole story. What I usually would suggest to, especially a first-time fund manager, is to provide a qualitative update. How are your portfolio companies doing? The good and the bad. Stay open, honest, transparent. You don't want to highlight just your successes, but you want to talk about your failures too, because there might be an LP within your LP roster that can help out during those hard times as well. I'm sure Matt has some insight into like how to maintain that LP GP relationship, but from my perspective, it's open, honest, and transparent communication.
Yeah, no, that's totally helpful.
Those are that's what you want, and I can kind of give you an example of kind of the good and the bad in these updates. We have one manager that we've allocated to who he's still small enough where, I've become kind of friends with him. We talk socially, we talk about restaurants, we're in the same city, whatever, try to hang out. But I could text him and say, hey, what's going on with company X? And he would reply. Now, I know that's not going to happen if you have 300 LPs and they're all texting you all the time. But his quarterly reporting, to Kristina's point, it's detailed. It's very, there's a narrative, and then there's a qualitative and a quantitative thing. And he's got one sheet links for each of the companies. So if you want a deeper dive, you click on the link and you go in, which is amazing, because you always kind of want to learn about each of the companies. But he also ranks them, I forget what the exact rankings are, but it's like launched, failure to launch, at risk, looking great, all that stuff. and they change quarter to quarter. Sometimes a startup has some really good momentum, and then all of a sudden it doesn't. And he takes a sober analysis of it, which I appreciate, because, like you said, it can't be all good news all the time. I mean, and on the other end, we are invested in another fund, and we also did a co-invest through them. And I think I emailed them and they're bigger, so I understand that the communication's not the same. But I emailed them, I want to say September, and they just asked for a specific update on the co-invest, and they just never replied. I chased them very recently, and I was like, hey, can you guys provide an update? And the last email was 9 months prior, and then they finally gave it. But to me, and it wasn't like I emailed one person, it's like the whole team that we know there, and no one just bothered to reply, which, to me is not great. It's not hard. Like, they should know how their portfolios or companies are doing. They could give, and I wasn't asking for audited financials or anything. I was just like, what's going on? How are we doing? And, but yeah, so I think, like we were saying before, you'd hate to think that you just wire your money someplace and then they never speak to you again because they got your money, so they're moving on to the next thing. So I just think the constant or the open communication and honestly, we've all been ghosted on an email before. It's not great. Like, it's not hard to reply to an email.
Mm-hmm.
So those are like kind of layups that some people miss, I think, and it's really, again, an easy one to kind of just make sure, listen, reply within a few days to every LP email you get, even if it's, I'll follow back up. That would be fine by me.
Yeah.
But, so those are kind of, again, that's opposite ends of the spectrum for us, but we obviously like the guy who provides the more update, the other updates and the one-cheaters more from a communication standpoint.
Yeah, and I totally agree. I mean, I think when you're thinking about raising and kind of getting to your first close, there's a lot of funds that have been able to be really good at showing activity. So they're raising and deploying at the same time. So they're at a certain percentage of their fund close rate, and then they're giving updates saying, hey, here's a new deal that I'm working on. And this is why I think it's really interesting. So I think kind of sharing updates on the activity that they're doing, I think that also kind of keeps the momentum going with the LPs that are kind of possibly somewhat interested, but they haven't pulled the trigger yet. They're kind of still getting to know you. So I think just seeing that you're active versus kind of, hey, thanks for the update on your deck, and then never hearing from them again. I also see a lot of fund managers that have been really good with just digital content, just kind of sharing, knowledge that they've received in the last couple months, whether it's via video or whether it's a LinkedIn post. People that are kind of building in public, I've seen that be pretty engaging. And there's a lot of LPs that are on Twitter that may not be as vocal, but they're definitely watching, and they're following different hashtags and different groups and different fund managers. So they're definitely out there in Twitter land, but they're not probably, we're probably not aware of who they are or where they are, but there's definitely people observing. So what about, just challenges and conflicts? I think we talked about just kind of effective communication. So just kind of sharing those, challenges up front. What are some ways that people can just handle conflicts with LPs effectively?
Yeah, I think this goes back to the open and honest communication. If you have your door open for LPs to approach you when there's an issue, you can address it before it starts to bubble up. The biggest one that you're going to run into, or not really run into, but the hardest one to solve for is a defaulting LP. But you can always get ahead of those things if you have that open door of communication, and maybe you can come up with. I think the thing that you want to take back is there's always going to be some sort of middle ground. Whether it's a defaulting LP, maybe you figure out a way to decrease their commitment, or if it's a special report, you could walk through with the LP, try to figure out what they're trying to solve for, or why they're trying to solve it, and figure out how you can come to a middle ground to do it together. I think a lot of what we're going to say here, and I'm sure Matt, you'll probably agree, is just communication, open communication, transparency, and being approachable, really.
That's actually a really good example. I've heard a few instances of that occur, and I didn't go as deep in terms of what was done to resolve the issue. So let's say hypothetically an LP defaults, and obviously there's certain terminology in the LPA. What are some of the options? So you can decrease you can kind of negotiate with that LP, but I guess what if the round is closed or like everything has been, pretty much closed, right? So then I guess what are your options there beyond decreasing, I guess, because if they defaulted, there's no way to get the.
Yeah, I mean, I've seen a couple of different paths. There's different sides of the spectrum. There's the one side in which you just wipe away their commitment, even if they funded in their capital calls, like prior ones, and defaulted on let's say the last two. You wipe away their entire commitment, and then you reallocate that to the other LPs. I've also seen GPs work with the defaulting limited partner. Let's say they funded in half of their commitment, but not the other half, decrease their commitment to be that whatever their funded is, and then they're 100% funded. There are a couple of other pathways as well, but those are the common ones that I've seen. And it really depends on, the LP GP relationship. Let's say, the LP reaches out and is like, hey, I'm having a hard time. I might need to adjust my commitment. More often than not, you're going to find a GP that's willing to work with them. If it's just like failure to pay your capital call and there's no communication, you're more likely going to get that other solution of defaulting on your entire commitment.
Yeah. Matt, at the fund level, and I know you guys have gotten several different types of flavors of communication, and it sounds like you're getting really good communication with the people that you're working with closely. But what are some of the maybe stats that you like to see high level in, fund updates, and also the cadence, do you like to see them ideally if you're an LP monthly, quarterly, and what are some of the high level things that you like to see in that update? And we have a couple templates that I can share for like LP updates, but would love to hear just from your firm, hey, we'd love to see, the last couple deals they've done, or hey, we'd like to see the recent updated TVPI that they're at right now. But if there's any kind of granular stats, I think that might be helpful for some of the fund managers.
Yeah, I mean, I think early days when there hasn't been a chance, DPI is going to be the most important one. I think should be the most important one for any LP. MOIC IRR are great, and those are indicative that you're headed in the right direction. But, we've all seen examples of a company that's rocket ship straight up, and then they get out too much, and then the valuation craters, and then your MOIC is gone, your IRR, and you haven't received any cash. So that is, again, but if you're a year into your fund, you're most likely not going to have any DPI. So those other metrics are good. They're helpful benchmarks, but ultimately, I think over the life of the relationship with the fund manager, I just care about DPI. Now, when there's updates for, quarterly updates, you want to know any new investments that have been made. I would prefer that as they make new investments, they would send a communication out and say, hey, we just invested in X at this number, blah, blah, blah. But I understand that that's probably not always a reasonable expectation. So quarterly is fine. A friend of mine told me he invested in this fund. He showed up at their annual meeting and he hadn't heard anything in like 6 months. And all of a sudden there's a big screen and they had made like 15 investments that he never knew about, never heard about. He's like, that would have been nice to know as an LP where my money is being spread around to.
Sure.
So yeah, I think outside of, so just knowing what the fund is up to, knowing, and maybe, if you could share kind of the pipeline, that's great too. But again, I understand it's confidentiality stuff and you don't want certain deals getting out there, but really any new investments made and the standard metrics. But again, ultimately DPI is the most important over the lifetime of the relationship with a fund manager.
This is a fun one. So tell me how GPs should effectively hold an AGM. So what are some of the pieces of content and community building that they should cover? And I've been to a handful of them, and they've been great. And they've had some guest speakers. They've had just a high level roadmap of just kind of what's coming up in the future, and then kind of reflection on what they've done in the last year and maybe some of their learnings too. And some of them have been very honest too. These are things that we missed, and these are things that we want to hopefully optimize for in the coming months. But you've probably been to a lot of AGMs, so just what's some advice that you would give to managers as they're kind of scaling and thinking about their next fund to kind of build a little bit of momentum about the AGM?
guest speakers and everything's great. And obviously you want to know how the portfolio is doing. You want to see that the GP's up there saying, this is where we did well. This is where we struggled. This is the reason why, this is how we're going to solve all that stuff. I think I've been to a couple for one of our, the funds that we've been invested in, and they seem very extravagant. And some of the other LPs were like, are we paying for this? Like, why is this being held at Soho House or whatever?
Yeah.
I love an open bar as much as anybody, but I don't you don't know if it's coming out of your pocket or not, part of the management fee and all that. So, I guess like the larger the fund, probably and the bigger, you need big event space if you're going to do it in person.
Yeah.
And, obviously if you have hundreds of LPs, you need a big space, but it's just, and some of the other LPs were like, this is great. And some of them were like, what's going on here? Are we paying for this? And I was like, I don't know. We're new here, so we're just trying to figure it out. But that's, again, I much rather a GP stand up and give their presentation and say, again, like we were saying earlier with the updates, good and bad. You want to know, I have more confidence in a person who's able to admit that they've made not made a mistake, but something they decided on didn't work out, than I am someone up there making excuses and saying, well, this was out of our control.
Yeah, that's fair. How about you, Kristina? You probably, seen a lot of funds kind of do community building and get everybody together in person. Anything to piggyback off of Matt's comments?
No, just feel free to invite your service providers is all I have to say. We're more than happy to attend them. We could probably help with, doing some of the quantitative reports or analysis, but we getting invited to them, it makes us feel like we're doing a good job and we're part of the team. That's the only comment that I have there.
No, I totally agree. I think there's different layers of information that you can share with people, right? There's a holistic view that could probably be presented in a more visually appealing way, especially if it's on a deck. And I think that could be something that they could partner with you on. And then obviously there's much more granular reporting that, again, you still need to make it visually appealing. You're not going to run through an Excel spreadsheet in the AGM on a big screen and run through all of that stuff with everybody. So I think just kind of working with you guys as a partner to kind of visualize that better and maybe make sense of it too. I think a lot of times there's a lot of numbers and there's different ways in general, there's different ways to understand performance. So making performance easy to understand, I think definitely helps. Kristina, you can probably share a lot of insight in terms of performance, right? So how, what are some of the different flavors and ways that performance is presented? And what are some watch points that fund managers should think about to make sure that they're not misleading as well when it comes to performance?
Yeah, I think Matt hit it on the head of saying DPI is the most important one.
Yeah.
That's cash over cash. I see a question here. How do I feel about TVPI early on? I mean, if that's the only measurement you have, I think that's a great performance metric, but it tells almost the whole story, but it's more of a paper story. One thing that you want to make sure that you're doing, especially when it comes to fundraising, is share the metrics that the LPs will care about. Don't necessarily share only the gross IRRs of portfolio companies, because that only tells part of the story. It tells how good you are in investing, not how much money the LP is getting off of those investments. It doesn't show how good you are at managing expenses or, tailoring manager fees or stuff like that. So if you're trying to talk to the LPs about what's important to them, tailor all of those performance metrics to what it looks like from an LP's perspective, what their dollar gets back for them, whether it's in IRR percentages or dollar over dollar metrics, or even the TVPI, I think is helpful if that's the only metric that you have early on.
Yeah, no, that's helpful. And then as far as track record, what are some ways that people can kind of build that track record? Maybe if they're an angel investor and they want to kind of start thinking about their fund one, what have you seen in terms of, kind of showing kind of some past deals that they've done in the past?
Yeah, I think angel investing is huge. Getting your first fund off the floor is pretty difficult. A lot of the times we'll see like a proof of concept fund or a friends and family fund where it's not necessarily like $10-15 million in commitment. Maybe it's $2 or $3 million just to prove that you know how to run a fund and you could take a dollar from year 1 all the way to year 10 and do it effectively. Those are the two probably low-hanging fruit. Obviously, not everybody has friends and family that can throw hundreds of thousands of dollars at you, but if you do, definitely see if you can leverage that.
Yeah. How about you, Matt? Have you any advice for people trying to build a track record?
Yeah. Short of being, a founder, angel investor, whatever, I think I think I was touching on this earlier. If you have a clear idea of what you want to do, and you can kind of prove out that there's an opportunity for large gains in this specific industry area or type of company, whatever it is, I think that for me would, and as long as there's a personality fit as well, I think that for me would be much more compelling than someone trying to raise a generalist fund for their first go round and just being like, I don't have, which is what we're, ironically, which is what I'm kind of doing at CC3. We're just generalists going out and finding deals we like and doing, but I would never ask someone else for their money to go out with that thesis. You know what I mean? So I think if you've got a clear idea of what you do, like, for example, we're only going to do, I think I said it before, enterprise software. We're only going to do repeat founders, and this is what we're going to start. These are the reasons why we think there's an opportunity here, and this is what we're going to stick to. To me, the track record is less important than it would be if you were like a big generalist type of thing.
Yeah, I think you're alluding to my next question, which is differentiation. So how can people differentiate themselves? There's so many AI funds, there's so many deep tech funds, and many of them, the content that's in the deck could be similar. So what are some things that they can lean into to differentiate themselves? I mean, one thing definitely that I've seen is just their story. So, something that's just super authentic about them and their journey to building this firm, I think definitely resonates with people. But any insights that you guys have, because you guys support so many fund managers and, obviously there's several LPs in your community. So how can people stand out in such a huge crowded market of talented fund managers and a very competitive market as well?
There's a couple of things that I would note is you don't want to stand out for the wrong reasons. So if let's say you're raising your fund 1 or even your fund 2 and you don't have that track record of high performance, don't go crazy with your fund terms. Don't say I'm going to take 30% carry or like my management fees are 3.5%. Like, just don't stand out for those reasons. I don't know what's happening, but I hear like a weird thing. Anyway, the person's story or like the story behind the team or what the team's strengths are and how you're going to get exposure to those portfolio companies, I think that's going to be big. It's one thing to say, like, I think this market is going to be huge. It's another thing to say how you're going to expose it. So focus on, again, the how or the why behind you as a person or you as an investor versus like the market itself or even, standing out for the wrong reasons.
That's really helpful. I think there's some construction or something here. It sounds like a sander or something. But anyways, what about teams? So what should people think about when they're building a team? Some people that are, building a smaller fund 1 or a concept fund, they're not going to have the budget to hire a full-time analyst, right? So there's people that are probably coming in as a venture partner or in fractional capacity. So what are some of the different flavors of teams when you think about fund managers, and what have you seen to kind of help people scale and be the most efficient?
Usually fund 1, fund 2, it's usually a single member, maybe one GP just trying to prove out their theory. As you grow as a firm, you take on more people, you have more manager fees to pay for it. You can introduce more venture partners. You probably have more institutional investors that'll look for a more segregated or dispersed team. But I guess my suggestion would be start small and then grow. Don't overbuild your team before you actually have proof that it's going to work. That's usually what I've seen. I don't know, Matt, if you have any other suggestions there.
Yeah, from the family office side of things, I would say that we're most focused on meeting the people we're going to be investing with. And generally, again, with kind of the size of our family office at the moment and the checks we're writing, that's most likely going to be a small team. So you can kind of go in and meet everybody. Kristina made a great point. You don't want to build out an entire team of however many 10 people when you haven't raised a dollar yet. Like, I would think that would be wasteful, and that waste would translate to me thinking, what are you going to do with my money once I invest it? So I think And also part of the team for me, I mean, we're all in the venture space. We've all met or heard of or read about like the arrogant founders or, the founder as God type guys, and fund managers can be like that too. I shy away from that sort of stuff. So you go to meet the team and they're talking about how great they are. To me, that's a little bit of a turnoff. But some LPs like that stuff, so I think when you're building out your team, you've got to be able, almost like a chameleon, to be able to talk to a lot of different types of people. You could, I know a guy in Austin who's like a third generation trying to get his grandfather to third generation family office, trying to get his grandfather who built his business in like manufacturing to invest in venture. He's like, well, how do I convince him to do that? So if I'm a fund manager, I'm talking to the grandfather different than I'm talking to the third generation, 30-year-old guy. So I think your team has to be nimble and flexible and again, be who you are, but you have to kind of be a little bit of a chameleon. You got to kind of know who you're talking to, I think, especially early days when you don't have a track record to run on or you're building your track record. Joel, you're muted.
Can you guys hear me? Yeah. So can you guys hear me now? Yeah. So I kind of had an interesting similar story. So there was a family office that is kind of taking on the venture practice of the family. And this person has engaged with many of the fund managers in my community. And what's really interesting is the father, the patriarch of the family, still has pretty significant influence. So there's probably a different narrative that you have and a different level of relationship building, not only when you're meeting that point person that you met, but then also separately when, that person's father is on the call, because there's probably some unique dynamics with the son and the father, kind of running the family office or kind of being the next generation to take on the family legacy, so I think that's really interesting. And a lot of times too, it's like if the patriarch doesn't sign off, then the deal won't go through. So I think you have to kind of build that relationship with multiple family members. And there's definitely a generational difference with like a next gen that's kind of more modern and tech savvy versus probably the family that gained their wealth through some other means. So really just trying to think through how you can educate and also engage with both of those different parties, because they're both still stakeholders to still, give you a chance and work with you.
Yeah, and I live in Texas, and so you run into a lot of people in the oil industry there. So try to get, the patriarch who's used to getting a check every month for his oil investments to give someone, a significant amount of money with a 5, 7, 10-year lockup here, or with no liquidity. It's probably a tougher sell, So you really got to be on your game with something like that, and you've got to, again, I think you've got to talk to, you got to be able to speak to, a lot of different types of people and types of investors, and really kind of hone in on what people's interests really are to try to keep, everyone aligned.
Well, that's interesting. So with you being in Texas, Matt, and, all of us just kind of coming from different geographic regions, and Kristina, I know your team is, you have multiple offices and different team members all over the place. What's the biggest differences that you've been seeing in the LPGP ecosystem? Maybe let's start with the West Coast and the East Coast in terms of kind of the market right now.
I can't say I've seen too much of a difference, at least from an admin perspective, in terms of like geography, but you could definitely tell the difference in terms of type of investor. So, the high net worth individuals are going to ask a lot less questions than the institutional or even the family office investors, or at least, like an institutional investor might have a specific report that they want specific information on. They're a little bit more involved. I wouldn't say I've noticed too much of a difference from West Coast investors versus East Coast investors. There's a lot more Midwest investors that I've noticed. That would be the biggest trend that I'm seeing. But other than that, I can't really tell the difference based on the stuff.
Yeah, I mean, the feedback I got just from speaking to someone a little earlier this morning is, there's just a lot of access and education on the West Coast, especially some of these families come from tech, so they're kind of already exposed and they have access, where I feel like there's a lot of real estate families that are still maybe trying to learn, the venture ecosystem and kind of still dip their toes in. So there's a little more receptiveness to hear about the opportunities versus, some people that are already kind of plugged in. they've already gotten kind of the deals from their community and their network, and they're kind of happy with that. So they're not often, maybe stepping outside of the access that they have. But again, that's just one person that I spoke to on the West Coast. I mean, one big learning that I had, kind of doing community building on the West Coast, I think there's definitely traffic to consider, like where, a lot of the high net worth individuals or family offices that do live in the city, it's just much more easier for them to attend events. So there could be a 50-50 chance where if you're trying to do like an LP dinner or an LP cocktail event, some of these people are thinking through, their commute, especially if they live outside. I mean, there's like an hour commute and people are driving. So those are some of the things I'm learning in terms of like just kind of in-person connectivity.
Yeah, and the only thing I would add, kind of the West Coast. So we know that this fund that is based out in LA, they sent one of their partners or soon-to-be partners to move to Austin specifically to build out a Texas LP base. Mm-hmm. So there's so much money in Texas, and I think it's probably it's definitely a tough state to crack. Just kind of what I was saying before about the oil and gas, kind of the generational money that's there. But this guy's full-time job, he goes to Houston, he goes to Dallas, he's in Austin, he's out in San Antonio, he's all over the state trying to just build up an LP base. And so like for a bigger fund out in California to send a full-time employee there, I think speaks a lot to kind of the opportunity in Texas, but also maybe they've got everyone they can get in California and they've got to go out there now. And another thing, I mean, you don't have to be based in San Francisco anymore as a fund manager for sure. Especially post-COVID. I mean, we have fund manager, at Vector, we look at our sales by state, and I think, we've got most states covered at this point. So there are managers everywhere, and good ideas everywhere. 10 years ago, Austin has become a tech hub in the last 10, 15 years or whatever. I mean, to Kristina's point, we know a few fund managers that are based in the Midwest specifically because they're like, there's no one here. We're going to start building out a presence here. So
sure.
I think there are LPs everywhere. So
what would be some wisdom that you would advise someone that's kind of moving to one of those cities in terms of like educating like an oil and gas family? What are some ways that you think they could kind of be a little more engaged? Is it really just kind of giving them the education, or is it, relationship building, all the above? But specifically for people that have traditionally been in the oil and gas space, how could we kind of get them to have a little more awareness and just kind of be aware of kind of the venture market and the opportunities?
Yeah, that industry is very relationship driven. So if you can, whether it's befriending the grandson and trying to get to the patriarch or whatever, or building the relationship that way. Yeah, it's like the old cliche about if you've met one family office, you've met one family office. That's kind of oil and gas are the same. It's all different families doing their own thing. So, but generally speaking, I think just how building personal relationships would be the way I would go about it if I were raising money in Texas.
Yeah, no, that's helpful. Kristina, any other advice you have in terms of just kind of giving, providing some type of awareness and knowledge to LPs that may not be in the traditional asset class?
I think just communication. Treat them as if you'd want to be like the way that you'd want to be treated. Treat them as your client. I think Matt said it before. I have it in my notes of what I wanted to say before is, as soon as they sign the subdoc, your journey's not over. It's just begun. And chances are they're going to be with you for 10 plus years. So treat them as you'd want to be treated. And if they need any kind of exposure, leverage your network, just build that relationship equity, which is how we build the admin business, is with the relationship equity. Treat your LPs or your investors the same way.
Yeah, so we've got a question here. This is probably for you, Matt. Like, what are your thoughts on solo capitalists for first or second funds? I guess do you prefer from your perspective to have somebody that has more of an established track record, or do you think you guys are open to taking a chance on someone that's kind of a founder building something from scratch?
Yeah, I mean, if solo capital is meaning solo GP, I mean, we've invested in one of those who just started building out a team on his third firm. So, again, for us, it's really about the personal relationship. You know, do we like this person? Do we feel like we can trust this person? Do we kind of seem to align on where we want these things to go? And yeah, so that's it. So whether it's a big team or a one-person shop, I mean, we consider everybody on the merits and kind of really, again, we're heavy on the personal side of things just to make sure we kind of click with the person and we feel like we can have a good working relationship.
Yeah, no, that's really helpful. And I got one or two more questions. So I know we're heading into a couple minutes till the end of the podcast, but one thing that I think could be really inspirational, Kristina, is you talking through some of the things that you've seen as fund managers evolve, right? So what are the changes that you've seen in a good way where fund managers, they've deployed fund one, they're thinking about fund two, maybe from the infrastructure standpoint, maybe in terms of like how they're building their team, their culture. You know, what have you seen successful fund managers do in their evolution? You know, some of the feedback that I've gotten in terms of their strategy, if they are changing their strategy, they need to be super thoughtful about it. So if they're kind of, you know, starting to expand in a new industry, right? They were a fintech fund and now they're doing, you know, some deep tech as well. You know, what is the intention around that? So those are a couple of pieces that I've gotten, but just walk me through kind of the evolution from fund one to fund two, things that you've seen that have kind of slowly evolved and developed.
Yeah, I think it goes back to, you know, expanding your team as your firm evolves, right? So let's say your first fund's $15 million fund. You're most likely going to get $300,000 a year in management fees, give or take. Like how many people can you actually employ and be able to focus full time on that fund, right? So like think of that as you expand. The more management fees you have, the more you can pay people to focus on investing and doing right by the fund. The one thing I think has been cool over the past couple of years is there's been hires at venture firms focused solely on community and operations, like expanding not just, you know, the LP base, but their horizons and the knowledge and education in venture as a whole. That's been pretty cool to see. As far as like what's been successful and what hasn't been successful, what I enjoy seeing is people knowing where their strengths are, and then not necessarily going past those strengths, but embracing them. For instance, you know, a $30 million fund, you're an early stage investor, doesn't mean you're going to be successful at running a $300 million fund. They're substantially different vehicles to run, and your investment thesis has to change. Like you mentioned, you have to be very thoughtful of that. But if you're good in that $30 to $50 million space, you don't necessarily need to go out of it either.
Can you go a little deeper? So, I mean, you've probably worked with some massive funds as well. So, like, what have you seen change drastically? When do the drastic changes happen, right? I mean, I would say, like, if you're probably $500 million, I mean, you've got like a capital formation team. And then I would say there's probably, you know, some of these massive family offices, I've seen them have little pods for different fund strategies, right? So they have a whole team with essentially like a GP, and then they have a whole IR team, and I guess the function is called capital formation. But you know, they've got one entire strategy that's a fund to fund, and they have another maybe $100 million fund that's doing directs and late stage. But we'd love to see, like, learn a little more about the world that you've seen. It, you know, when you really scale into kind of that institutional phase, you know, way beyond like the emerging manager status.
Yeah, I mean, from our perspective, again, we're involved in like the financial reporting and the admin side. So going deep into the construction of a venture firm is not necessarily something that we're really exposed to. But I can say that as you start to think of fund 3, fund 4, that's when you start to think, hey, do I need some sort of outsourced CFO or in-house CFO and expanding the finance team or the back office team internally? Even at that point, it gets difficult for a single member or dual member GP, or even just GPs in general, to manage the financial responsibilities of keeping your LPs up to date. So those are the evolutions that I've seen. Is like there's a certain threshold with the number of funds or AUM that you're managing that you need to start to bring in people that do do less of the investing function and
Mhm.
more of the functional work behind running a venture firm.
Yeah, so it's essentially inserting strategic people to partner with you better, so that they can kind of, handle the back office more efficiently at the firm level, and then also keep close contact with you guys as well to ensure the reporting is.
And a little bit more than that as well is like you can have your CFO's extra function be helping out some of your portfolio companies, make sure that their books are being kept in accordance with or like help them with strategic visions of where they want to go from a financial perspective in the future. But it does definitely streamline at least the admin relationship.
Yeah, absolutely. Matt, any final words in terms of fund evolution and maybe any advice for fund managers?
I think I touched on it a little before. We've had fund managers who are raising a fund 3, and they're like, this fund 3 is going to be $40 million. Fund 4, 5, and 6, if we get there, are going to be $40 million. We're going to keep repeating, doing what we're doing. We think there's enough opportunity here. To me, that makes more sense than someone saying Fund 3 is $40 million, Fund 4 is going to be 500, Fund 6 is going to be $3 billion. Then I kind of just wonder what it is you think you're doing. Like, that's obviously not what got you to the point. I get you want to, more AUM, but I think there comes a point where, depending on what you're doing, where you go from depending what your strategy is and what stage, but you go from a venture fund to a big private equity shop, essentially, where your returns aren't going to be, you're catering to institutional investors. Your returns aren't going to be what they were when you're writing smaller checks or at earlier stage stuff, which is fine. But I think if you call it Fund 4, it's really not that's not the same thing to me. It's not the same strategy. So
Sure.
Again, all those things are fine. All those things are totally fine and understandable. I'm just, for me, I would question what, I don't know that I would want to be on the next however many funds, even if I were in the first couple, if they start to grow that much, because it's kind of a different thing to me. That's my opinion.
Yeah, absolutely. Well, hey guys, really appreciate your time, and we learned a lot today. So super grateful for the friendship as well, and hope to see you guys in person at some point soon.
Thank you, Joel.
All right, take care, guys. Have a good one.
Thanks, Joel.
Bye, everybody.
Thanks, everybody.